Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 8:52 p.m. Central Time Sunday night, and I'm recording this in preparation for the market day of Monday, May the 23rd, 2016. I'm in the middle of traveling from Chicago to our new home in the Montana Rockies, and looking forward to being there and getting settled and getting my trade desk set up for one thing. But we will be traveling all day Monday as we cross North Dakota into Montana. So we're going to go ahead and get this video produced tonight, Sunday night, in anticipation of Monday. There'll be no futures numbers for overnight, but most of the other information is already put together, and we can go ahead and get some thoughts put together about this. Remember that on the YouTube, you can have a free subscription to the channel and be alerted to new content once it's being published. And indeed, once I get settled in on my new Montana trade desk, given that we're on Mountain Time, I may at times record on the evening before, and sometimes as a backup record the next morning. So being a subscriber to the YouTube channel will allow you to know when that content's actually been published and be able to pick up on that. Once you get that notice from YouTube, you probably want to wait a couple minutes to allow the content of that video to be available in high definition. The charts and so forth look a lot better in high definition. Also, note that the setting button, you can choose to play that high def playback level, and at the same place, you can also control the speed of the playback. I routinely find that I listen to videos from other authors at about 1.5x the recorded speed, and am able to pretty much understand everything I need, and then I slow it down if I need to, if there's something of particular interest and I want to make sure I don't miss anything. But it's a very flexible tool, and allows you to take about a 20-minute video and listen to it routinely in about 13 minutes. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning reports. And we'll go to the regular morning report. Of course, I've blacked out the futures markets because they're open right now, but Asia's just started, and certainly there's nothing of significance of yet. What we did want to look at is in terms of the U.S. macroeconomic reports for Monday. We do have an FOMC member speaking early morning, and then we also will have one yellow report, flash manufacturing PMI. So pretty light action for Monday at the start of the week. And looking forward to Tuesday, I see new home sales and Richmond Manufacturing Index. So relatively light beginning of the week, but there are a couple things on the schedule that could give a little ripple through the market. In terms of current volatility conditions, we have been decreasing in volatility of late. And indeed, if you look down at the bottom, you see we had quite a little cluster there where 5 out of 6 trading sessions we were seeing standard deviation moves going both directions. So a lot of chatter really to not really achieve anything. That's been now followed by 3 straight trading sessions, at least on the S&P, where there are no standard deviation moves. We did have standard deviation moves put in by both the Russell and the NASDAQ on Friday, so keep that in mind. Primary market we focus on is S&P, and that was a little bit calmer. Also note that its cousin, the Dow, was also a bit calmer than the Russell and NASDAQ. Short-term VIX, look at this, 12.73. We've seen some figures down as low as 12 in recent trading weeks, but certainly this has started to calm down. Skew just above the threshold of 125, at which we call this a caution. There we go. And in terms of IB percentile on the S&P, all these are still very, very low. S&P 14, Russell 16, NASDAQ 12, Dow at 11. So that's also keeping things kind of under control at this point. In terms of current charts, let's go ahead and look at the S&P futures. And you can see the market has opened at this point. You started to get a candle form, a little bit of negative action. It's also up off its low of the overnight, but very, very low volume thus far. Not much happening of yet. This will be much more meaningful tomorrow morning after you get those to Asia and the European markets contributing in a significant way. One thing that we want to take a look at, though, is that while we've had this kind of descending pattern of lower highs, similar highs, lower lows, just channeling down after the huge run up, about 13%. We've just had this short-term pattern that's been consistently to the downside. Well, we thought that we were going to see a breakdown of the head and shoulders pattern. Here's your left shoulder, here's your head, here's your right shoulder. We had a neckline right across here, and sure enough, on Thursday we broke that just to reverse intraday and close back up. So this is one of the tricky things about chart patterns. We always look for these kind of false breakouts. And while technically it triggered the neckline, the close back up inside this chop and this consolidation zone really kind of calls that into question as at this point. Now, Friday's action was back up, and so far today hasn't done anything. So we'll continue to watch and see if we get a break of this neckline, and not just a break, but a close, especially a close and then confirmation below that. If we see that, we may start to see, some gathering momentum and energy. If that happens, and remember I said if that happens, we could see a drop of about 100 points in the S&P, probably taking us down from about 2020 down here probably until about 1925, somewhere right around here, would be the target for this breakdown of this chart pattern. So just keep that in mind, that with a confirmed breakdown, there could be some short-term opportunity to the bearish side, and it would probably happen pretty quick. Now, hasn't happened yet. So what happens if we don't break that? Well, then we probably see ourselves deteriorate into some sort of sideways range-bound action, which would be very, very typical of summer doldrum kind of activity. We're playing right at the top of the cloud. We get into the cloud. That, by its definition, is neutral, and we could see a lot of chop in that pattern, and that could potentially go for a number of weeks. Now, the third possibility, of course, is that the bulls regain their hand and then take us back to the all-time highs. All-time highs are up here about 2130-ish kind of areas, and that was over a year ago now. Actually, this chart here, let's go. So you can see the 52-week high is now 2127, but that's not actually the high. You now have to go more than a year back to be able to see those May highs of last year. And I think it was 2134 on the, if I remember the number right. Maybe that might have been, I can't remember if that was the S&P futures or if that was the SPX. But bottom line is the all-time highs are sitting, right up in this area right here. And so that third possibility, the first possibility being that we break the head and shoulders pattern, break down. Second possibility be a sideways pattern. And the third possibility that we make a run for the all-time highs. Frankly, at this point, I think that's the least probable scenario between these three scenarios. But we'll see as this information develops, as we get resolution of this pattern one way or another, and see where that goes. Let's go ahead and take a look at the Dow for just a moment. Dow looks very much like the S&P, and they have been in very high correlation with each other in recent trading sessions. NASDAQ and Russell have departed some of late, and you see the NASDAQ, it's already in this sideways chop inside this cloud like we talked about. It's, by definition, is neutral and on the intermediate term. So short-term pattern was bearish, but then it's gone neutral now. And, there's not really a head and shoulders there or anything like this. It's just kind of a sideways range-bound market with respect to the NASDAQ until it breaks out of that cloud to the top or the bottom. And then with the Russell, it's kind of like the S&P playing right at the top of the cloud. Short-term pattern has been lower. You've had a series of lower lows and lower highs that have been coming into play. So we continue to watch how this develops until we get a higher high. It's hard to give too much credence to the bulls on either the Russell or the NASDAQ. And really none of the indices are screaming in terms of opportunities for the bulls. Let's go ahead and take a look at the VIX and see if that's giving us any indication. We've had this break up on volatility, though that, rolled right back over. So we did get a higher high. Let's see where volatility retraces to, and indeed if it starts to climb back up. That might be a bit of a tell as to where the equity market is going to go. And the other tell, we often look at the bond market, and bonds had broken up and cleared an awful lot of overhead resistance, came and broke for a couple weeks up above the pattern, but then with the action in the middle of last week really got clobbered and now is up against that resistance once again. So bonds don't seem to be telling us that equities are going down. Now, this was in reaction to the FOMC news of last week, and a lot of the interest rate products, certainly took a hit along with the bonds. So it may be more about the interest rate information than it is a flight to safety versus a flight to more stock-oriented investing. So right now, this seems to be responding to its interest rate variable more than a fear factor playing into rotation into the long bonds. Now we can also take a look at gold, and gold has gotten really sloppy here. We've looked for this series of breakouts, and you can see here we've been talking about this slop before it finally broke up, but then just another really poor kind of pattern. I mean, I guess you could call this a complex bull flag, but in the short term, we're seeing lower lows and lower highs, and now another lower low. And at some point, we've got to see where that swings and see if that gives us another lower high. But at this point, it's starting to call into question whether gold is going to make that big move up towards 1350 or 1400 even that many are anticipating. I kind of suspect that it will eventually, but how long will it take to get there is probably the bigger question, because it's clearly having a pronounced amount of time in these sideways chops in between these bursts that seem to be coming with gold, which is really tricky because if you're not in it, you don't participate in the burst. You wake up one morning and the burst is already there and it's left you behind, just to then go into a sideways pattern for the next 3 weeks, it seems like. So gold, not the simplest market to trade. And then let's see, what else might we look at? Oh, crude oil. We might take a quick look at crude oil. Crude oil, probably ever since its bottom reversal down here, has been one of the more consistent performers and really continues to make a series of higher highs and higher lows. And significant resistance probably just above, though. So, to go long at this point, would look to be pretty difficult until it clears this swing high right here. Now, once it clears that, we could probably make a run to the 53.5 and then on all the way up to 60. So there's definitely some room for this to move above if it wants to continue to build on that energy momentum. But right now might be a point to wait and be patient for a new trigger entry. That's probably enough on the charts for tonight. Let's go ahead and go to the daily report. A couple of things have been changing here. Not so much in the top in terms of scores changing enough to change the bias. We're still intermediate term phase opinion phase 5. The in short term, the break with diagonal and horizontal support, that's a warning. And then our 3 mechanical signals. The first one, IBD, uptrend under pressure still, end warning status. The second one, GMI index, a 0 out of 6 with a sell signal in place since 5-4, and that author still mostly in cash. In terms of decision point, the third mechanical signal continues to be really poor, and we just frankly, for our best investing and trading, where we can just kind of roll out everything we've got in our arsenal and just kind of really go at it, we'd like to see these stacked, and this is just about as messy as it gets. Short term, of course, quite bearish with some neutrals, of course. I guess we need to give credit to that. Intermediate term has been starting to show some deterioration, and then this is all against the long term that has absolutely given us mixed signals. So it's just as messy as you can get, and guess what? That's a reflection of the chart on the ES, where we have been sideways now for months, and we continue to talk about that. But it's just a really poor market to be able to kind of gain any kind of significant ground at all. And just a second here. My mouse seemed to have frozen for a moment there. Give me a pause here for just a second, folks. I'd hit the pause on my recording, but I can't move my mouse. Just a second here. Okay, I think we saved our mouse and got a new battery in it and can proceed forward here. So let's move on down to the position sizing opinions. Both signals are coming in at the same, the first one at 50% and the second one based on volatility at 75%. In terms of intermediate term market posture, once again, we go into a bull signal, this time a weak bull, first day weak bull signal. Now, keep this in context. We have had a series of these weak bull triggers where we have this intermediate term market posture turn bullish and then just fail after 1 or 2 sessions. We're very, very suspicious of these signals right now. So while technically the mechanical signal is giving us permission to initiate new short-term and intermediate-term bullish trades, I myself will not be acting on that at this time. We're still at hedge warning status 2 overall. That's a red light. And normally I would not be at level 2. At the same time, I have an intermediate term market posture of weak bull. But in putting, this is where the judgment comes in. I use a lot of mechanical, very objective-oriented signals, but I do allow myself to ultimately bring a consensus to all these different metrics into play. And I look at things like market posture. I also look at, what these volatility warnings are telling me, intermarket risk aversion indicators. I look at all these things, and then ultimately I make a decision as to where to put that hedge warning status. And I've found in the past that when this intermediate term market posture turns first day weak bull, that is a pretty poor probability play. And I would just exercise some caution before I would act in any big way. Now, if you want to be speculative or aggressive, keep the position size small and perhaps scale into the position. Don't go gangbusters on just a first day weak bull intermediate term market posture. I mean, this could roll back over and go strong bear literally in a session. That's just how weak this signal is at this point. So I mentioned the hedge warning status is still at hedge level 2, which is red light for the initiation of new positions on short to intermediate term. In terms of the special opinions, there were no changes on this since last week. The VIX is technically in the acceptable position to be able to initiate new positions for novice traders for option income strategies. However, there are multiple other warnings, and the suggestion is significant defensiveness on the initiation of new positions at this time. Both covered calls and put selling, really kind of poor conditions to be putting on new covered calls at this point. And level 2 would basically flat out tell us we don't have permission to put on our typical, what we call our covered call mastery trading plan cover calls that we use in the trading room. In terms of put selling, if you're aggressive, this is perhaps the strategy that you use to start the process of initiating new bullish positions. In this case, of course, you just have to be not too long when you're selling puts on stuff that you're willing to own. So think about that. So perhaps not speculative put selling so much as building a position on stock that you're willing to own. Use defined risk positions, have a put spread instead of just naked puts, and make sure you scale that and the size that you're willing to own should this market break down. If that head and shoulders pattern breaks down, frankly, you could find yourself with much better places to be buying in a very quick order. And that's a very high probability pattern. It's probably one of the best patterns for significant follow-through of all the intermediate term patterns that we watch for. In terms of the specific warnings, you see distribution day count at the NASDAQ's at a 9, the S&P's at a 7. It's been hovering around this area in recent trading sessions. If these get to 10, we'll probably see that hedge warning status increase to even a 2+ or ultimately to a 3, our highest level. So this condition, could very easily trigger at the same time we see that head and shoulders pattern break down if that were to happen. Skew is just barely at a warning status, about a 9% probability of a 2 standard deviation move in the next 30 days. Also note that in terms of intermarket risk aversion indicators, we're getting really mixed signals here. These have been improving. At the same time, the market's been deteriorating in so many other ways. These have started to show improvement, and we now have 3 of them as risk on, and the other 2 are rolling up and close to giving a risk on signal. So would seem to be very contrary to what many of the other indicators are doing, but this is one of those signals that we look for is to see when the tide changes and when things start to roll, and maybe the bulls are coming in and the tide is changing. So it's hard to discount this. We've put a lot of value into these indicators being something of an early warning sign of a change in the momentum between the bulls and the bears, and they're very consistently have been changing from 5 of them being off as risk off to now 3 are risk on and the other 2 are close to giving us that signal. The fear and greed index, and we're starting down here into our sentiment, very, very neutral, just above the neutral setting of a 50. Intermediate term market postures, we look at short to intermediate, quite a rainbow of color here. Let's focus on the ones that are most consistent: healthcare, energy, financials, and materials. Kind of a mostly higher beta, but healthcare thrown in there. For a market being as much with a kind of neutral to bearish posture, these aren't the sectors that you would necessarily point to. Now, materials, of course, have been in something of a rebound. Financials were helped with that FOMC decision. So that's where some of this is coming from. Materials and energy are kind of related with much of this that's happening in the commodity space, and then financials from the FOMC decision. So maybe it's not so much about risk on as the individual stories that are going on with some of these sectors at this point. The ones that are most decidedly down, retail's improving, but it certainly has really taken a hit of late. In terms of percent change, you see on Friday, information technology, healthcare, consumer discretionary, materials, those were the ones that performed the best, while consumer staples was the only sector that was actually negative for the day. So there you go with there. But also note the 5-day, the 1 month, decidedly negative for the 1 month basis at this point. So it's kind of interesting to see how this has been going. Here we got green and then a whale of red. Yet 3 month, nice performance, and then the year to date in 1 year, mostly, especially on the 1 year ago, mostly red. This is just that sideways market. As we get near the tops, it seems like everything turns green. But then as we go towards the bottoms of the ranges, we see a lot of deterioration. Ultimately, the buy and hold crowd have made very, very little ground in the last 18 months to show for their capital, and must be a very, very frustrated lot trying to make something when the market's basically in the same place it's been for the last year. In terms of intermediate term market postures for the various ETFs, there's no new changes here. We still have a broad range of ETFs that are still intermediate term market posture bullish, so you've got to keep that in mind. When we look at the relative rotation graph, though, what an ugly mess here. Really nothing that is, strongly moving into this upper right quadrant, and I think that's very telling. It's hard to believe, frankly, that we're going to see a significant run towards those all-time highs when you got so many of these kinds of tails that are kind of fleeing that upper right quadrant. It's hard to see new time highs with this kind of behavior. So we've gone about 26 minutes today, so let's go ahead and wrap this up and get this thing published. And let's go ahead. I'm going to just scroll. If you see something of interest, just hit the pause button, go to that hyperlink. You can get additional information. We'll talk more about this in the days to come. I need to make more time for some of this stuff. But in the meantime, certainly when it comes to the disclaimers, if you need more time to review these disclaimers, definitely hit the pause button. And also note at the hyperlink here at the bottom, the full set of disclosures. In the meantime, we'll see you back here for the next trading session. Probably we'll record on Monday night for Tuesday, as we are basically about halfway through Montana. Montana is a colossal big state, and we're moving to our new playground in the Montana Rockies, and very much looking forward to being there, but it's going to take us a while to get there. So we'll probably do our Tuesday session with a recording on Monday evening. Looking forward to seeing you then. In the meantime, good trading.